Most traders don't lose because they lack a good strategy. They lose because they can't wait. The market seduced them into believing that every flicker of price, every twitch of movement is an opportunity. They act not from clarity, but from the need to be involved. The irony is that the more you need to trade, the less likely you are to wait for the kind of setup that actually aligns with your edge. Waiting isn't just about time, it's about mental discipline. The ability to do nothing when everything in you screams to do something is one of the hardest skills to master. The market has no obligation to reward impatience. It moves according to its own rhythm, independent of your desires or expectations. To learn how to wait for setups means learning how to surrender control, not in a passive way, but in an active state of readiness. Every trade setup has a structure, a pattern, a set of conditions that define your edge. That edge doesn't appear constantly, and it certainly doesn't appear just because you want it to. The trader who cannot wait for those conditions to align ends up trading random noise, reacting emotionally rather than responding strategically. They confuse activity with progress and motion with mastery. When you truly understand your edge, you begin to see that most of the time the market is simply not offering you anything of value. The market spends far more time consolidating, misleading, and setting traps than it does providing clear high-probability opportunities. The professional knows this. They are patient because they accept the reality of uncertainty. They've learned to let go of the emotional attachment to constant action. The novice, on the other hand, is still looking for excitement, still chasing validation through the next trade. To wait for a setup means to stand in complete neutrality while the market reveals itself. It's not about predicting, it's about allowing. It's a quiet confidence, a calm readiness to act only when the conditions are right. No urgency, no anxiety, no need to force. You observe, you assess, and when your setup appears, you act decisively, without hesitation, without fear. Patience in trading is not a passive quality. It's an active discipline that requires awareness, emotional control, and a deep respect for probability. The best setups come to those who have learned to detach from the constant need for confirmation and outcome. When you learn how to wait, you align yourself with the rhythm of the market rather than fighting against it. True mastery begins when you realize that doing nothing is often the most profitable decision. Waiting for your setup is not wasted time, it's preparation. It's the space where emotional balance meets technical clarity, where the trader finally becomes one with the market's flow instead of its victim. Patience in trading is often misunderstood. Many believe it's simply the ability to wait, to sit idle until something happens, but real patience is far deeper than that. It's an active state of mental control, emotional balance, and heightened awareness. It's the deliberate choice to stay disciplined while the market tempts you with constant motion. The mind wants to act, it seeks engagement, especially when uncertainty stirs emotion. But patience, true patience, is a form of strength that expresses itself through stillness. It's the invisible force that separates the professional trader from the impulsive one. Every tick, every candle, every price move whispers to your subconscious mind, urging you to react. The market is designed to trigger your instincts, fear of missing out, fear of loss, greed, and the constant need to be right. The inexperienced trader interprets this stimulation as opportunity. They confuse excitement for clarity and motion for signal. The patient trader, however, understands that the market's movement is not a command but an invitation. And not every invitation should be accepted. The market will always be there. Opportunities will always form again. What will not always remain is your mental balance if you continually give in to every impulse that flickers across your screen. Patience as an active skill means engaging your awareness in every moment, observing without reacting, analyzing without interference from emotion. It's not about ignoring the market or suppressing your desire to act. It's about transforming that energy into focus. You use the time between trades to prepare, to refine your understanding of setups, to evaluate risk, and to strengthen your conviction in your edge. Every minute you wait with awareness, you're sharpening your mental tools. Patience becomes the foundation of your consistency. A trader without patience is like a soldier who fires without aiming. The outcome may occasionally be lucky, but it's never sustainable. The reason patience must be practiced as an active discipline is because your psychological conditioning resists it. The human mind evolved to respond to uncertainty with action. In nature, hesitation could mean danger. In trading, that instinct works against you. The impulse to act to escape discomfort becomes your enemy. Learning patience requires rewiring that instinct, retraining the mind to see inaction not as danger, but as control. When you're waiting for a setup, your emotions often rise to the surface. You might feel restless, anxious, or doubtful. You might fear that you're missing the real move. You might start convincing yourself that near-perfect setups are close enough. These moments reveal your level of discipline. True patience is not about waiting comfortably. It's about waiting while discomfort tempts you to break your own rules and still maintaining your composure. It's not passive sitting, it's active self-regulation. The patient trader knows that opportunities in the market are never scarce. They understand that trading is a game of probabilities, not possibilities. Every setup has a statistical edge that plays out over time, and only by waiting for those exact conditions to appear can you remain aligned with that edge. Entering prematurely distorts the probability in your favor. It becomes gambling dressed as trading. When you have patience, you're protecting your edge by refusing to dilute it with impulsive decisions. This kind of patience also reflects confidence. You cannot wait calmly unless you trust your process. When you doubt your system or your understanding of the market, you will feel compelled to act, to prove something, to force outcomes. The professional waits because they trust. They know that they don't need to chase. The market will always give another chance. Their patience stems from conviction, not hesitation. It's an inner knowing that doing less but doing it precisely leads to greater results over time. In every moment of waiting, you're practicing awareness. You're observing the structure of the market, reading the language of price action, recognizing the emotional rhythm of the crowd. You're cultivating the ability to see beyond surface movement and into market intent. The market constantly oscillates between balance and imbalance. When it's balanced, nothing is happening. This is where impatience destroys most traders. When it's imbalanced, setups appear, and this is where patience is rewarded. The transition between these states defines opportunity, and the patient trader is always ready for it because they've conserved emotional energy instead of burning it through meaningless trades. Patience also filters noise from information. The modern market is overloaded with data indicators, news releases, social media opinions, flashing numbers, all designed to provoke reaction. Without patience, you'll drown in it. The ability to filter requires space in your mind, and space can only exist when you're not frantically jumping into every perceived opportunity. When you practice patience, you create that space. You begin to distinguish between what matters and what doesn't. You stop reacting to random volatility and start responding to meaningful structure. There's also a subtle psychological shift that happens when patience becomes part of your trading identity. You stop measuring success by the number of trades you take and start measuring it by the quality of your decisions. Your relationship with the market changes. You no longer need the market to validate you. You start to feel detached from its fluctuations. That detachment is not coldness, it's clarity. It's the freedom to see the market as it is, not as you wish it to be. This form of active patience requires constant reinforcement. Every time you avoid a trade that doesn't fit your plan, you strengthen your discipline. Every time you wait through a false move without reacting, you're training your nervous system to remain calm under pressure. Over time, this rewires your trading psychology. The market will still move unpredictably, but your reactions won't. You'll begin to see that waiting isn't wasting time, it's building power. Every second of stillness before execution adds precision to your action. When the moment finally arrives, patience also preserves capital, both financial and emotional. Each impulsive trade costs not only money but mental focus. It drains your energy and clouds your judgment. The patient trader protects these resources like a professional athlete protects their strength before competition. You conserve yourself for the setups that truly matter. This conservation builds a compounding effect. Your best trades are executed with full clarity, undistorted by the fatigue of unnecessary engagement. In trading, the difference between randomness and consistency lies in how you manage time between trades. The impatient trader fills that space with noise, constant chart watching, overanalyzing, forcing entries. The patient trader uses that space as preparation, studying patterns, reviewing performance, staying aligned with the plan. The external appearance may be the same. Both traders are looking at charts, but internally the experience is completely different. One is reacting, the other is preparing. One is consumed by fear, the other is guided by focus. To develop patience as an active skill, you must learn to trust the process over the outcome. You cannot control what the market does, but you can control when you engage with it. Patience is that control in its purest form. It's a silent agreement between you and your discipline, a commitment to wait until your system speaks clearly. It's not about doing nothing, it's about doing only what matters. When you embody patience, you begin to sense the rhythm beneath the market surface. You can feel when energy is building, when conditions are aligning, when something meaningful is about to unfold. You no longer need to chase. You simply observe, breathe, and act with precision when the signal appears. In that space of waiting, your edge is protected, your confidence is sustained, and your focus becomes unshackable. Most of the market's time is not opportunity. This is one of the hardest truths for traders to accept. The charts move, candles form, prices fluctuate up and down, and yet beneath all that motion, very little of it represents a moment worth acting on. The illusion of constant opportunity is the trap that consumes most traders. It gives the impression that something is always happening, that there's always a trade to be made, that the next move could be the one. But the professional knows that most of the market's activity is just noise, random, meaningless fluctuation that serves no purpose other than to stir emotion and create confusion. The ability to see this and to remain detached from it defines maturity in trading. Noise is seductive because it mimics opportunity. It looks like movement, and movement triggers a psychological urge to participate. When price spikes or falls rapidly, the brain interprets it as urgency, a call to action. This is how traders get caught reacting to every flicker. But true setups, the ones that align with your strategy and statistical edge, are rare and deliberate. They take time to form. They appear only when a specific structure, confluence, or pattern emerges in alignment with broader market context. These moments are the minority. The rest of the time, the market is simply oscillating with an indecision, creating false signals and baiting impatience. To recognize that most of the market is noise requires a shift in perception. You must stop viewing the market as a constant source of potential profit and start seeing it as a landscape of probabilities. Within that landscape, the high probability zones, your setups occupy a very small space. The rest is uncertainty. The novice trader spends most of their time trying to find trades within that uncertainty, while the professional spends most of their time waiting for clarity to appear within it. The difference lies in perspective. The market is not a machine that produces money. It's a reflection of human emotion and collective psychology. Most of what you see on the chart is just the crowd reacting, guessing, hoping, panicking. Only at certain moments does structure emerge from that chaos. The reason most traders lose isn't because their strategy is bad, but because they mistake noise for signal. They trade during low probability conditions and then wonder why their results are inconsistent. Every strategy has a time when it performs best, certain volatility conditions, certain patterns, certain alignments of trend and momentum. The rest of the time, even the best strategy fails because the underlying market environment doesn't support it. The professional understands this and filters ruthlessly. They have learned through experience that being selective is not a limitation but a strength. The market's design reinforces the illusion of opportunity. Every tick, every movement is an invitation for emotional participation. Platforms are built to amplify that. Flashing numbers, ticking charts, constant updates. The system feeds on engagement. But the professional trader learns to see through this illusion. They know that real opportunity doesn't announce itself through motion. It reveals itself through structure. A setup that aligns with their edge, fits within their risk tolerance, and offers a clear definition of invalidation. That kind of clarity is rare, and that rarity is precisely why trading requires patience. Understanding that most of the market is noise also changes the way you use time. Instead of trying to trade constantly, you begin to allocate your focus toward analysis, observation, and preparation. You start to develop a feel for rhythm. When markets are active and directional versus when they're choppy and indecisive, you stop fighting the market's natural cycles and start flowing with them. When there's nothing to trade, you study, you plan, you rest. When opportunity appears, you act decisively. This cycle of waiting and acting creates balance. It keeps you emotionally stable and mentally sharp. Noise also plays a psychological role that must be understood. The market uses noise to test your discipline. Every small fluctuation challenges your conviction. Every fake breakout tempts your fear. Every pullback provokes doubt. If you don't recognize these as noise, you become reactive, jumping in and out, overtrading, second-guessing yourself. The professional has trained their mind to remain still in the face of this chaos. They know that reacting to noise is the same as abandoning control. They choose to watch rather than chase, to observe rather than interfere. Their edge lies not in predicting every move, but in identifying when the market environment supports their method. When you understand that most of the market is noise, you start to interpret movement differently. You realize that price action is a language, one that speaks in probabilities, not certainties. You begin to see false moves for what they are. Traps for the impatient. You see how the market creates illusionary signals to attract liquidity, to lure traders into taking positions that fuel the next real move. In this sense, noise is not random. It serves a psychological purpose in the market's mechanism. The crowd reacts to noise, the professionals wait for structure, and the professionals profit from the crowd's reaction. The discipline to stay out of the market during noisy periods is a form of strength most traders never develop. They feel that if they're not trading, they're falling behind. But the market doesn't reward effort, it rewards alignment. You can't force opportunity to appear by being more active. The more you engage with noise, the more your capital and confidence erode. Each impulsive decision taken in noise conditions weakens your psychological foundation, making it harder to act with clarity when true setups arrive. When you internalize the reality that most of the market's time is just noise, you begin to redefine what productivity means as a trader. Productivity is not measured by the number of trades you take, but by the quality of your decisions and the consistency of your process. Waiting becomes part of the work. Observation becomes part of execution. The hours spent not trading are not wasted. They are essential to maintaining the precision required when your edge finally appears. This understanding also sharpens your risk perception. Because noise dominates most of the market's activity, risk is constantly present. Every entry into a noisy environment carries hidden danger. The probabilities are lower, volatility is unpredictable, and direction is uncertain. By recognizing this, the professional naturally trades less but wins more. They accept that their job is not to participate in every move, but to identify and execute within the few moments that have statistical significance. There's a deep psychological freedom in accepting that you don't need to trade all the time. Once you no longer feel pressured to act, your focus expands. You begin to see the larger context, the interplay between trend, volume, sentiment, and structure. You stop zooming in on every candle and start understanding the rhythm of the entire market. This shift from micro-reactivity to macro-awareness transforms how you perceive setups. You begin to sense when the market is preparing for something meaningful. Traders who fail to grasp this concept remain trapped in cycles of overtrading and frustration. They misinterpret randomness as opportunity, constantly switching strategies, chasing indicators, and blaming conditions. They live in reaction rather than observation. Their results fluctuate because they're trading in an environment that offers no statistical edge. The professional has broken free from that cycle because they've learned that doing less, when done correctly, produces more consistent results. When you internalize that most market time is noise, you stop competing against it. You stop needing to be in the market at all times. You realize that your power as a trader lies not in your ability to predict, but in your ability to filter. The market doesn't owe you opportunity, it offers it selectively. The ones who wait for it see it clearly. The ones who chase it drown in noise. And that difference between reacting to randomness and responding to structure defines the entire psychology of successful trading. True discipline in trading isn't revealed when you're taking a trade, it's revealed in the moments when you decide not to. The ability to do nothing when conditions aren't right is the purest expression of control. It's where most traders fail, not because they lack technical knowledge, but because they can't sit still when the market is moving. The mind is conditioned to equate movement with opportunity, and in trading, that instinct becomes poison. Discipline begins where impulse ends. It's the deliberate choice to stay inactive until your edge appears, even as the market teases and provokes you with endless motion. Doing nothing might sound simple, but it's one of the hardest actions a trader can perform. The need to trade is deeply psychological. It's fueled by the illusion that participation equals progress, that more trades mean more chances to win. Yet the market doesn't reward effort, it rewards precision. Each decision to trade without proper alignment between conditions and strategy erodes your edge, slowly destroying the consistency you're trying to build. The disciplined trader understands this and resists the urge to engage prematurely. They know that real control isn't expressed through constant activity, but through the restraint to wait. When you can do nothing in uncertain conditions, it means you've accepted the fundamental truth about trading. You don't control the market. You only control yourself. The market will do what it wants, when it wants, and it owes you nothing. Most traders fail to internalize that truth. They try to force the market into their expectations, trading from a place of hope rather than probability. The disciplined trader has surrendered that illusion of control. They accept that their only power lies in their own behavior, their own timing, and their own ability to act only when conditions match their predefined criteria. Discipline in trading is emotional management disguised as structure. When you follow your plan, when you wait for the setup that fits your system, you're not just executing a rule, you're regulating your emotions. Every trade decision is a psychological event. Impulsive trading is not the result of bad analysis, it's the manifestation of fear, boredom, or greed. The moment you act from emotion, you break the integrity of your process. Discipline is the mechanism that keeps your decisions aligned with logic rather than emotion. It's what separates professionals from gamblers. To do nothing in uncertain conditions requires a deep sense of confidence. You can't wait calmly if you don't trust your method. You'll constantly feel anxious that you're missing out, that someone else is catching the move you ignored. The market amplifies that insecurity through volatility and noise. Prices spike, retrace, and break out, and each movement whispers, "You could have been in this." Without discipline, you'll fall for that whisper every time. The disciplined trader knows that missing a random move is meaningless. What matters is sticking to the structure that defines their edge. Every moment of restraint reinforces your psychological foundation. Each time you resist an impulsive trade, you strengthen the neural pathways of discipline. You're training your brain to associate inaction with safety rather than fear. Over time, this rewiring becomes automatic. You no longer feel the anxiety of waiting. You begin to feel peace and patience. The ability to do nothing becomes as natural as breathing. That's when trading starts to evolve from chaos into clarity. The market is designed to exploit emotional weakness. Every false breakout, every sharp reversal, every unexpected surge exists to test your discipline. It's not personal, it's simply the nature of a probabilistic environment. The disciplined trader recognizes these traps and remains detached. They know that reacting to every flicker of movement leads to exhaustion and inconsistency. Instead, they observe, they analyze structure, context, and volume, waiting for alignment. Their discipline acts as a filter, allowing only high-quality setups to pass through their decision-making process. Doing nothing when conditions aren't right doesn't mean disengaging completely. It means staying alert, watching with awareness, preparing mentally for when the environment shifts in your favor. The mind remains active, but the hands stay still. It's a controlled readiness, an internal stillness with external awareness. You're not detached from the market. You're attuned to it, observing without interfering. This balance is the essence of professional discipline. Traders who lack discipline often mistake randomness for opportunity because they're emotionally attached to the idea of constant participation. They can't stand the feeling of being out of the market. That feeling of missing out is in truth fear. Fear of being left behind, fear of watching others profit while they stand still. But that fear blinds them to the reality that most of those random moves would have resulted in losses had they participated. The disciplined trader doesn't fear missing out, they fear breaking their rules. There's a kind of invisible energy that builds when you do nothing in the face of uncertainty. It's the energy of self-control. Each act of restraint adds to it, creating internal strength. You become more stable, less reactive. You stop being swayed by the market's noise. Instead of chasing, you allow the market to come to you. This psychological shift reverses the dynamic. You stop being the hunted and become the observer. The market no longer dictates your behavior, your discipline does. Doing nothing also preserves emotional capital. Every impulsive trade doesn't just cost money, it drains confidence. Each time you act against your plan, you subconsciously weaken your trust in yourself. This erosion leads to hesitation when real setups appear. You begin to second guess, doubt, and hesitate. The disciplined trader avoids this cycle by maintaining consistency. By doing nothing when the setup isn't there, they protect not just their balance but their belief in their process. Discipline is not rigidity. It's not about denying emotion or suppressing instinct. It's about channeling both within the boundaries of structure. When conditions align, discipline transforms into decisive action, fast, confident, and precise. But when conditions are unclear, that same discipline expresses itself through stillness. Both expressions are part of the same skill, control. The undisciplined trader lacks this duality. They act when they should wait and hesitate when they should act. The disciplined trader knows the difference instinctively because their process defines it for them. There's an important psychological paradox here. The more control you try to exert over the market, the less control you actually have. But the more control you exert over yourself, the more aligned you become with the market's natural rhythm. Discipline bridges that paradox. It keeps you synchronized with probability rather than emotion. By doing nothing when conditions aren't right, you align your behavior with the only thing that matters, the statistical reality of your edge. Every market condition communicates something. Sometimes it speaks clearly through structure and direction. Other times it's fragmented, indecisive, and inconsistent. The disciplined trader listens. They know that acting in uncertainty is like speaking over the market instead of listening to it. They wait for the market to communicate in their language, the language of their setups, their system, their plan. Anything else is noise. In trading, doing nothing is an act of confidence, not hesitation. It's a reflection of mastery over emotion. When you can stand still in the middle of chaos, you've achieved a level of control that few traders ever reach. It's the quiet power that allows consistency to emerge. Each moment you refrain from forcing a trade reinforces the structure of your mind, and that structure becomes the real foundation of your success. Waiting aligns you with probability, not emotion. This is the core truth that separates trading as a discipline from trading as a gamble. Every market movement is uncertain, every outcome is unknown, but probability gives structure to that uncertainty. The moment you act from emotion, fear, greed, frustration, or excitement, you detach yourself from that structure and step into randomness. The ability to wait is what keeps you tethered to probability. It ensures that your decisions arise from logic, not from the shifting tides of your emotional state. Waiting is not just a behavior, it's a mental alignment with how the market truly works. Probability governs every aspect of trading. No trade is ever guaranteed, no setup ever certain. What defines an edge is not prediction, but a favorable likelihood, a condition where the odds tilt slightly in your favor. Acting outside those conditions means you're trading against the math, substituting reason with impulse. The trader who waits for alignment with probability understands this. They know that the market will always create emotional pressure, tempting them to trade early or late, to chase moves or to avoid discomfort. But probability doesn't care about emotions. It only responds to structure and consistency. To trade with probability, you must first accept the nature of uncertainty. Most traders never do. They try to predict instead of respond, to control instead of align. When emotions drive your behavior, you try to make the market conform to your expectations. You want it to move a certain way because that satisfies your psychological need for control or validation. But the market is not designed to meet your expectations. It's designed to exploit them. The moment you trade from emotion, you're offering liquidity to those who trade from probability. You become part of the crowd that professionals profit from. Waiting is how you protect yourself from this trap. When you wait, you're not passively doing nothing. You're allowing probability to present itself clearly. You're observing price behavior, structure, momentum, and context until they align with your predefined edge. That alignment is where probability exists. When you act only within that alignment, your results become consistent not because you're right more often, but because you're acting from a statistical foundation instead of emotional reaction. The essence of probability trading is repetition of high-quality decisions under specific conditions. Without waiting, that repetition becomes impossible. Emotion thrives in impatience. It wants instant gratification, immediate confirmation, and quick validation. Probability, on the other hand, demands patience, repetition, and neutrality. These two forces, emotion and probability, are constantly in conflict within every trader. The ones who succeed are not those who eliminate emotion, but those who discipline themselves to act according to probability despite their emotions. They still feel fear and greed, but they've learned a separate feeling from decision. Waiting is the mechanism that allows this separation to occur. When you wait, you create space between stimulus and response. The market moves, but you don't immediately react. In that space, your analytical mind has time to assess whether the move aligns with your edge. That pause, that moment of stillness, is where discipline lives. It's where emotion loses its grip and probability reclaims control. Most traders never create that space. They react instantly, driven by the need to avoid discomfort or seize perceived opportunity. Waiting is the conscious act of reclaiming that space again and again until it becomes instinctive. Probability is not exciting. It's repetitive, structured, and methodical. It's built on the law of large numbers. The understanding that consistency emerges over a series of trades, not from any single outcome. Emotion, on the other hand, is erratic and impatient. It judges every trade individually, labeling wins as validation and losses as failure. This emotional interpretation distorts your perception of probability. The trader who waits knows that any single trade is irrelevant. What matters is execution over time, following the same process under the same conditions repeatedly. Waiting aligns you with that long-term mindset, freeing you from the trap of emotional highs and lows. The market constantly tests your alignment with probability. Every false breakout, every reversal, every sudden surge in volatility challenges your patience. Emotion sees these moments as opportunities. Probability sees them as noise until proven otherwise. The disciplined trader waits for confirmation. They don't need to catch the very top or bottom because they understand that probability lives in confirmation, not prediction. Emotion wants to be first. Probability wants to be right often enough to sustain growth. Waiting allows you to position yourself where probability is visible, where structure, volume, and trend converge to form a valid setup. To align with probability, you must detach from outcome and focus on process. Emotion is obsessed with outcome because it seeks immediate reward. Probability doesn't care about any single result. It only cares that you followed your rules and acted when conditions matched your edge. When you wait, you're reinforcing this focus on process. You're telling your mind that your job is not to chase results but to recognize conditions. Each act of waiting rewires your perception of success. You start measuring yourself by how well you executed your process, not by whether the trade won or lost. The conflict between emotion and probability is most visible after a series of wins or losses. After wins, emotion breeds overconfidence, pushing you to take trades prematurely. After losses, emotion breeds fear, making you hesitate even when your setup appears. Waiting acts as the balancing force between these two extremes. It keeps you neutral. You don't rush after wins and you don't freeze after losses. You simply observe and wait for your criteria to align again. In this way, waiting isn't just tactical, it's psychological equilibrium. There's a rhythm in trading that only emerges when you operate from probability. You begin to sense the flow of the market. When volatility is expanding, when momentum is fading, when accumulation or distribution is taking place. You can't perceive this rhythm when you're emotional because emotion narrows focus and distorts time perception. Waiting clears that distortion. It allows you to see the broader context, to act with precision rather than impulse. You begin to trade less, but your timing improves. Each decision feels effortless because it's supported by probability rather than emotion. The mind resists waiting because it equates inactivity with missed opportunity. But in trading, the opposite is true. Every impulsive trade made from emotion is a missed opportunity to preserve your capital for when probability truly aligns. The more you wait, the more selective you become, and the more your trading edge sharpens. Over time, this selectivity compounds. Your losses become smaller, your wins become cleaner, and your emotional balance stabilizes. This is not because the market has changed, but because your internal alignment has. Probability rewards patience, not passion. It rewards structure, not spontaneity. To align with it, you must continuously monitor your internal state. Every urge to act prematurely is a sign that emotion is trying to take control. Every moment of calm observation is a sign that you're aligned with probability. This awareness must be cultivated deliberately. The more you observe without reacting, the more you build the mental resilience necessary to remain objective. The act of waiting also strengthens your trust in your process. When you see that your setups consistently appear after periods of patience, you develop confidence in the rhythm of your system. You begin to trust that the market will always produce opportunities. You don't have to force them. This trust removes fear and desperation, two of the most destructive emotional forces in trading. You realize that the market's randomness is irrelevant because probability emerges through repetition and discipline, not through urgency or luck. To wait is to be in harmony with the nature of the market. The market is not linear. It breathes, expands, and contracts. It offers moments of clarity followed by confusion. Probability exists only in those moments of clarity. By waiting, you move with that rhythm instead of against it. You allow the market to reveal its intention before you participate. Emotion wants to predict, probability wants to confirm. Waiting ensures that you act only when confirmation replaces chaos. When you trade from emotion, every tick feels personal. When you trade from probability, every tick is just data. That's the transformation that waiting creates. It shifts you from reacting to observing, from chasing to aligning. It turns trading into a process of precision instead of a cycle of emotional exhaustion. Waiting, therefore, isn't just about time. It's about identity. It defines the kind of trader you are, one who acts from probability, not emotion, and one who understands that patience is not delay but alignment with truth. Mastery in trading doesn't come from how much you trade. It comes from how selectively you act. Acting only when your edge appears is the purest form of mastery because it reflects complete alignment between discipline, patience, and understanding of probability. Every trader begins with the illusion that more trades mean more chances to win, but experience reveals the opposite. The market doesn't reward activity, it rewards precision. The trader who acts only when their edge is present operates from clarity, not from impulse. They understand that consistency comes not from being constantly involved, but from waiting until all conditions align in their favor. Your edge is the intersection of skill, timing, and probability. It's that narrow window where your understanding of the market and the current structure merge into a high probability opportunity. But that window doesn't appear constantly. The market spends most of its time fluctuating in uncertainty, creating traps that appear like setups but lack the essential alignment that defines your edge. The undisciplined trader confuses these for opportunities while the master waits. They know their system so deeply that anything less than perfect alignment is invisible to them. Acting only when your edge appears is not a passive philosophy. It's a deliberate, trained response built on thousands of hours of observation and self-control. Mastery begins when you realize that not every movement deserves your attention. The market is a sea of randomness punctuated by brief moments of structure. Your job is to recognize those moments, and only those moments. To do that, you must know your edge intimately. You must know what it looks like, feels like, and behaves like. You must know the context in which it thrives and the conditions under which it fails. This clarity doesn't come from studying price alone. It comes from studying yourself, your reactions, biases, and emotional triggers. The master doesn't just trade the market, they trade their own psychology in harmony with it. When you act only when your edge appears, every decision is grounded in logic rather than emotion. You're no longer reacting to price, you're responding to structure. This distinction changes everything. It removes the random, impulsive energy that defines the average trader and replaces it with deliberate precision. Every move becomes an extension of your plan. The waiting, the watching, the moments of silence, they all serve a purpose. They're not empty space, they're preparation. The act of not trading becomes as important as the act of trading because it maintains the purity of your edge. An edge is fragile. It's not just a set of technical conditions. It's a mental state. The moment you deviate from your process, the edge weakens. Overtrading, chasing, or forcing entries dilutes it. The master guards their edge with the same care a craftsman guards their tools. They understand that their advantage lies not in prediction but in timing. The edge is statistical, built from probabilities that play out over time. Each time you act outside it, you surrender your statistical advantage and step into randomness. A mastery means protecting that advantage through restraint and precision. The reason most traders fail to act only when their edge appears is because they don't trust themselves. They fear missing out, they doubt their strategy, or they crave the emotional stimulation of being in a trade. Mastery replaces that fear with trust. Trust in the process, trust in the probabilities, trust that the market will always provide another opportunity. The master doesn't need to chase because they understand that the market's rhythm is endless. There will always be another setup, another pattern, another cycle. Missing one doesn't matter. Acting without an edge does. To reach that level of mastery, ability, you must internalize patience as part of your identity. You don't wait because you're unsure, you wait because you're certain of what you need to see. There's confidence in that stillness. When your edge appears, you don't hesitate. There's no doubt, no fear, no second guessing. You act decisively, not because you're guaranteed to win, but because you know the conditions are right. This balance between stillness and decisiveness is the essence of mastery. It's what allows you to trade with both precision and calmness. Every great trader develops a deep respect for timing. They understand that timing is not about prediction, but about synchronization, aligning your action with the flow of the market. When your edge appears, you're not imposing your will, you're aligning with probability. You're stepping into harmony with structure. That's why mastery feels effortless, because it's not forced. It's the result of waiting until the market and your system speak the same language. Acting only when your edge appears also protects your mental capital. Trading is emotionally draining, especially when you're constantly involved. Every trade demands focus, energy, and psychological recovery. The more random trades you take, the more you deplete these resources. The master preserves them by trading less but better. They understand that mental clarity is their most valuable asset. By waiting for high-quality setups, they ensure that every decision is made with full attention and presence. This conservation of energy leads to consistency, while constant engagement leads to burnout. Mastery also involves complete acceptance of randomness. You can have the perfect setup and still lose because probability never guarantees outcome. It only defines likelihood. Acting only when your edge appears means you've accepted this uncertainty fully. You no longer need to be right, you need only to follow your process. Each trade becomes just one event in a long series where your edge will manifest over time. This mindset eliminates emotional extremes. A loss doesn't shake you, and a win doesn't inflate you. You remain balanced. because you know that your job is not to predict outcomes but to execute your edge. There's also a psychological freedom that comes from trading only your edge. You're no longer chasing the market's movement or comparing yourself to others. You're focused entirely on your own framework. Your trading becomes quiet, calm, intentional, and precise. You stop measuring success by daily results and start measuring it by consistency of behavior. This internal shift marks the transition from trader to master. You realize that mastery is not about outperforming others, it's about outperforming your own impulses. The market rewards this kind of discipline in subtle ways. When you act only on your edge, your losses become manageable because they occur under controlled conditions. Your wins compound because they're executed in the same disciplined manner. Over time, this consistency creates a statistical edge that compounds into exponential growth. It's not dramatic, it's methodical. The master understands that trading is a marathon of probabilities, not a sprint of predictions. Acting only when your edge appears also strengthens your intuition, but not in the emotional sense. It becomes refined intuition, born from thousands of repetitions of following your process. You begin to sense alignment without forcing it. You can feel when the market structure matches your edge, when volume supports movement, when price behaves within your expected parameters. This intuition is not guesswork, it's subconscious pattern recognition built through experience, but it can only develop when you're selective. Overtrading dulls intuition because it buries real signals beneath emotional noise. Patience and precision merge into one mindset when you act only on your edge. You no longer think in terms of time, you think in terms of alignment. You measure your readiness not by how long you've waited, but by how complete the setup is. You stop asking, when will the next opportunity come? And start asking, is this aligned with my edge? That simple shift defines professional thinking. It removes uncertainty because your decisions are no longer based on emotion or external pressure, only on the criteria that define your system. In this way, mastery becomes a process of subtraction, not addition. You don't need more indicators, more trades, or more complexity. You need less noise, less reaction, less deviation from your edge. Each time you remove something unnecessary, your clarity sharpens. You begin to see the market not as a battlefield, but as a series of patterns unfolding in time. Your role is simply to wait for the one that matches your edge, act with precision, and step aside. There's no struggle, no forcing, no doubt, only rhythm, repetition, and flow. Acting only when your edge appears is the discipline that transforms trading from chaos into art. It's the state where patience, probability, and emotional control converge. The master doesn't seek constant validation from the market. They seek consistency within themselves. They understand that the market's movement is infinite, but their attention is finite. By conserving that attention for the right moment, they turn every trade into a deliberate expression of skill. This is where mastery lies, not in doing more, but in knowing exactly when to do less.